Hi everybody, Jared Johnson here with Day Traders FX. I hope you're doing well. Today we're going to spend some time talking about option trading basics. Now we do a lot of talk about currencies and forex trading and so on. I want to spend some time talking about trading options. We've done a lot of option trading this year. So far it's been wildly successful for us. It's really, really great to do. Now, one thing that I would say that keeps people out of option trading a lot is some of the main option trading terms, right? You start hearing things like the Greeks, right? Delta and theta, and you start hearing things like intrinsic and extrinsic value, and you start hearing things like implied volatility and in the money and out of the money. And you go, never mind. That's complicated. I'm going to stick with currencies. I'm going to stick with forex because all I do is buy a contract or sell a contract. But option trading is actually quite simple. It's actually not very difficult at all. And I want to show you how to get started in trading options. We're not going to focus heavily on the real intense stuff yet. We'll have some videos in the future that go very much into detail with some of the bigger definitions. But right now what I want to focus on is just option trading basics. How can you get started trading options? What are some things that we need to know about? So let's focus on these guys right here. Calls and puts. Calls and puts. Now, if you're a golfer, you're going to want to say putts. It's puts. Okay, so calls and puts. These are kind of the basic contracts for option trading. Everything that we do is going to consist of buying or selling a call or buying or selling a put. And it's just kind of what combination we put them together. It's kind of like any ingredient, right? You can make a whole bunch of different kinds of food with basic ingredients, right? Option trading, there's a whole bunch of different kinds of strategies we can use with just calls and puts. It's just how we arrange them and understanding kind of how the principles work behind that. Now, but again, I want to focus kind of on the basics here. I want everybody to get involved in option trading because it's so important to get involved in this side of the market. We never want to be totally focused on one side or the other, options only or currencies only. We want to make sure that we can do both and take advantage of both because there's a lot of really great opportunity with that. So let's talk about what this means. Okay, so let's talk about calls first right here. Here we are on Southwest Airlines chart. You can see that Southwest Airlines is making a little bit of a move. The stock's trading at $47.59. If I want to buy some shares of Southwest Airlines, it's going to cost a bit of money, right? If I don't have a large account, buying 1 or 2 or 300 shares of Southwest is going to cost me thousands and thousands of dollars, right? So, so that's where options come in, is we can benefit from movements in stocks for a fraction of the money. If I want to buy 100 shares of Southwest Airlines, it's going to cost me $4,759. But if I trade an option on Southwest Airlines, it's going to cost me a fraction. I can buy a contract on Southwest for $150 or $200, and I can essentially control 100 shares of stock. Right? So if Southwest makes a big run up and I own a call contract, then I am going to make some pretty good money for a relatively small investment. So if we look at Southwest right here and we say, okay, here's the stock trading at $47.59. Let's say that I buy a $47.50 call option, meaning pretty much anything that goes above $47.50 is going to be looking pretty good for me. Further out I go, the more expensive it'll get. So if I go for like a 25-day expiration at a $47 Southwest call option, it's still only going to cost me around $240 or $250 to control 100 shares of Southwest Airlines. Now, this stock on its own, again, is going to cost me almost $5,000 to outright buy 100 shares. And there, of course, are benefits to just buying 100 shares of stock. But it's going to cost me almost $5,000 to own 100 shares of stock, or I can control 100 shares through an option for about $250. So that's a considerably lesser amount of money that I can control an option with. Or control shares of stock with this option. So just to be very clear, if I think the market is going to go up, I would potentially buy a call option, right? again, we're just going to go with some very basics here. I want to get everybody started and get the wheels turning on what options are. If I think that Southwest Airlines is going to continue higher, I'm going to buy a call option. The further out I go, the more that's going to give potential for this option contract to gain value, right? The longer this has to run, the more the airline stock could potentially go higher. So the further out I go, the more expensive that contract's going to get. Now you can see I'm 100 days out, and that contract's costing almost $450. Still, considerable amount less than 100 shares of stock, but considerably more expensive than maybe a 1 or 2 month expiration. So that's thing number one. That's where we want to kind of get our brains working. So an option contract has a couple of things, right? We have strike prices and we have expiration dates. Those are just a few basics. Every option contract, 100% of every option contract has a strike price and it has an expiration date. Now, what a strike price is this right here. So here we are looking at Southwest Airlines. This is our strike price. When we buy a call option and the stock price is above the strike price, our option is considered a little more valuable. And this is where the intrinsic, extrinsic value comes into play. And we'll talk more about that, but our option contract is gaining value, right? Because now we're saying what this strike price, one of the things that this strike price means for us is if I buy a $47.50 strike price on Southwest Airlines, let's say Southwest goes up to $60 over the next month, let's just say, I have the option to either sell my contract that I paid, say, $250, $300 for. I can sell it for an incredible gain, right? I paid, less than $300 for it. It might be worth at 65 bucks. It could be worth a few $1,000s, right? And so I could just say, hey, I'm not going to take ownership of this stock. I'm just going to sell my contract. I bought it for 300 bucks. I can sell it for $2,000 right now, just hypothetically. And so I get my 300 bucks back plus $1,700 in profit. That's great. I also have the choice or the option to exercise that option. I can say, well, heck, I paid 300 bucks for this contract at $47.50, and here's the stock all the way up at $65. I'm going to exercise the contract, and instead of taking profit on that contract, I'm going to now own the stock at $47.50, right? So the stock's trading at $65, but I own it at $47.50 minus the premium that I paid. And this is our option premium, this number 287, 294, that's always times 100. So if I pay $287 or $2.87, that's per option, but I always have to buy 100 options. Every option contract has 100 options, and that's the smallest size we can go is 100 options or one option contract. So I have to pay $287. This is my spread. This is our bid and ask, 287, 294. So I have to pay about $294, somewhere in the middle for that. But if this stock goes way up, I could say I'm going to exercise that. I'm going to own Southwest way down here, and I'm going to be in huge profit on this stock. Either way, I make a bunch of money, right? I can own the stock at a way lower price, or I can just sell the option contract, which is going to be worth far more, and never take ownership of the stock. Maybe I don't have a large enough account to own even the stock at $47.50. It's going to cost me $4,750 because I have to buy at least 100 shares. So maybe I just buy my contract for just shy of $300 and I sell it for $1,000 or $2,000, wherever it ends up being, and I don't have to tie up a bunch of money and I can make huge profits. That is awesome. Same thing on the put side, right? So a call option is if we think a stock is going to go up, and that's our strike price and our expiration, right? And our expiration is the other detail right here. This is a January 15th expiration, 40 days out. So I have until January 15th, right? And then the option will expire and it will cease to exist, and I've got to do something, right? Either take assignment, own the stock, or sell the option contract and just take my money and make a bunch of money on it. So that's our strike price and our expiration dates. And the same thing on the put side. So the put side would be, I think a stock is going to go down. Calls, I think a stock is going to go up. Puts, I think a stock is going to go down. And on my platform, everything over here is call options and everything over here is put options. So if I'm looking at Southwest Airlines and I say, you know what, Southwest Airlines is a terrible company for all these reasons, and I am going to buy a put. So here's Southwest trading at $47.59. Maybe I buy a $47.50 put. Now, as long as Southwest Airlines goes down, and let's say in a month or so, Southwest is trading at $40 or $35, my put contract is going to be making money. So calls are how we make money when we think a stock is going to go up, and then it ultimately does go up. And put contracts are what we do when we think a stock is going to go down, and then of course it does go down, right? So if you buy a put and a stock goes down, you make money. If you buy a call and a stock goes up, you make money. So these are kind of the very, very basics of option trading. Calls are the bullish market, and puts are the bearish market. So I buy a call option if I think the stock's going up. Oops, there we go. And I buy a put option if I think the stock is going down. Now, every call option and every put option is going to have a strike price and an expiration date. Typically, once again, the further out that expiration date is, the longer it gives that option to work and the more potential it gives you to make money on that trade. And so further out expirations are going to cost you a little bit more money. Closer up expirations, something that's 2 weeks out is going to be far cheaper than something that is 2 or 3 months out. And our strike prices is where we can either take ownership of the stock if it makes a big run for us, or it's just kind of our gauging point to say, okay, here's where my trade is in the money or out of the money. Here's where we're on the right side of this movement or not on the right side of this movement. So very, very basics about options. Calls, puts, strike prices, expiration dates, the very basics, right? Very, very basic. So just start getting this digested, start getting a little look and feel for this, and then we're going to talk in more detail about more technical specific terms of calls and puts. But let's go on to the next video where we get into a little more detail about calls and puts themselves. So thanks for watching. Hopefully this is helpful. We have a lot more to go. Thanks, everybody.